My name is Bill Nelson with Pacesetter Planning. It is, as of this recording, it's December 21st, 2017. You can see I have my Christmas tree behind me, and I've spent my last real work day before the holidays going through the almost 1,000-page tax reform bill that was passed by Congress yesterday. I don't think the president has actually signed it yet, but he is expecting to do so in the next couple days. And the reason why I wanted to do this chat this way today, I put about a 3,000-word summary of the bill and what's included in it up on my website. But I've heard a lot of questions about what exactly is in this legislation. There's been a ton of negative press around it, and I think justifiably so, particularly on the corporate side, which we're not going to necessarily get into here today. But instead, what I wanted to do is talk through exactly how this Tax Cuts and Jobs Act affects you as an individual taxpayer and what it's going to do to your taxes going forward. We are going to leave the corporate side out of this for today. I do have a couple notes in front of me. Believe it or not, I haven't memorized this entire law in the day since it's been passed. But I'm going to do the best I can to summarize what I think you really need to know, the most important things for you to know going forward. And by all means, if you have any questions as we go through, certainly jump in and ask them. One kind of important note I want to touch on before we actually dig into the substance here is that all of these changes are going into effect for the 2018 tax year. This bill was passed the second to last week in December of 2017. It's going into effect January 1st, 2018. What that means is that when you file your taxes on April 15th, 2018, none of these things apply yet. The new rules go into effect January 2018 when you file your taxes in April 2019. This is the first time any of these rules will really apply, with one big exception, and it's a really important one, and that is the repeal of the individual mandate under the Affordable Care Act, under Obamacare. And technically, it isn't actually a repeal of the individual mandate. Instead, what they've done is the individual mandate was designed to tax you if you didn't have appropriate health insurance for at least 9 months of the year. That mandate is still in place. Instead, what they've done is set the tax equal to 0. Effectively, it means they're not going to tax you if you don't have health insurance. You should still have health insurance. It's not a good reason not to. But be aware, right, that the elimination of the individual mandate tax doesn't actually start until 2019. So you do need to have health insurance in order to not pay that tax in the year 2018. But beyond that, everything else starts January 1st, 2018. But that being said, I think there are really some things that, particularly right now, in the last few weeks of December 2017, there are some things that we can do to prepare ourselves for the changes in tax code going forward. So if you're watching this live, there's a link pinned to the top of the Facebook page that has what I'm calling my tax hacks. There's 2 pages to the document, one of which is a summary of things that you might want to consider to prepare yourself for these tax changes if you happen to be watching this and see that guide before the end of 2017. There's also a second page that actually talks about some strategies that you might be able to use to minimize your tax burden starting in 2018 and beyond. So I don't necessarily, again, right, we have a couple weeks to really take advantage of some of this stuff. By all means, there will be plenty of things for you to benefit from it if you catch this in 2018. If you are watching the replay of this, I'll have the link in the video description. If you're watching it live, that link is at the very top of the Facebook page right now. But with that, let's actually dive in and talk about what this tax bill actually does. And there really are kind of 3 levels that I want to look at it from. The first is what happens to your actual tax rates. The second is what happens to the deductions that you're able to claim. You're able to eliminate some of your taxable income through provisions in the tax code. We'll talk about what happens with that going forward. And then finally, there are some tax credits as well, which are essentially deductions in the actual amount of tax that you owe that have changed a little bit under this provision as well. So we'll go through those one by one. First and foremost, the tax rates. The good news here is that for just about everybody, people's marginal tax rates are going down. almost across the board. There are a few groups of people who are not going to see a decrease in their marginal tax rate, and there are actually a few groups of people who are actually going to see a slight increase in your marginal tax rate. Those are primarily individual taxpayers, so people who are not married, who make somewhere between about $150,000 a year and $400,000 a year. So it's a pretty wide range of people who, if you have taxable income in that range, your marginal tax rate is actually going to go up a little bit. The good news is that because the rates below your current marginal rate are all going down, you're still very likely gonna end up with a slight tax cut. Depends a little bit on your situation. We'll talk about that a little bit as we go. But that's just something to be aware of, right? For the most part, everybody's tax rates are going down. I have the old and new tax codes for single and married people up at pacesetterplanning.com. So you can definitely feel free to take a look at those, find your income range, and see exactly what's going to happen to your tax rate. Like I said, overall, the good news is that most people are going to be getting a tax cut, just in terms of their actual individual rate under this bill, which is good news. The other component, though, is to the actual income side, and figuring out kind of what your income tax rate is going to be. There's another component that's a little bit different and a little bit more interesting that I want to talk a little bit about. This is not going to apply to everybody. But for people who either work for a very small business or are self-employed or have the ability to be an independent contractor or are an independent contractor in your current job, or even people who have some sort of side hustle, right, that are, driving Uber is a good example, right? People who essentially work for themselves or for a very small business, at least according to the IRS. There's a change that you need to be aware of, and the IRS is, the tax bill is calling it a pass-through business, essentially a business entity, usually just an individual who's working for themselves. That money goes into the business and just essentially gets funneled on to the individual people in the business. These sorts of pass-through businesses don't pay corporate income tax rates. If you're an independent contractor, you don't pay a corporate income tax rate, even though the IRS views you as a sole proprietor business. Instead, the income gets passed through to you, and you pay your own individual income tax on that income. Your tax situation, if that applies to you, is going to change a little bit, really for the better, actually. So pass-through businesses under this new bill, starting in January of 2018, are able to deduct 20% of their income before they actually go and file taxes. So what this means essentially is that if I make $200,000 a year, that's a bad example, I'll tell you why in a minute. If I make $100,000 a year as a sole proprietor, rather than pay taxes on that whole $100,000 worth of income, 20% of that's going to be eliminated. So I'm only paying taxes now on $80,000 of that income, which is kind of a big deal, right? That really is a very drastic shift from the way our tax code has worked to date. And we've seen this trend over the past 5 or so years where more and more people are working for themselves, either as independent contractors or with some sort of side hustle. Frankly, I think that this provision is only going to exaggerate that over time. Really, the new tax law really incentivizes people to become independent contractors. There's some other downsides of that. You might not get health insurance or a 401k through your work. But be aware, particularly if you've thought about starting a business or you actually run a business yourself, this change is very real for you. Now, there is one caveat to it. I alluded to it a second ago, is that not all pass-through businesses are treated equal under this bill. Particularly any service-based business, as defined under the law, has some caps as the amount of income you can earn to have that 20% deduction from your income. Specifically, it starts, if you're an individual filer, it starts at about $155,000. If you're a married filer, it starts at about $315,000. After that, you start to fade out over time, your ability to take that 20% deduction. What is a service-based business that are capped by these rules? Really any sort of business that provides some sort of professional service. Legal services, health, doctors, accountants, financial services such as myself, really any sort of professional services firm is going to be subject to this, with two exceptions. I don't know why, but they excluded engineers and architects from that cap. So if you're an engineer or architect, deduct 20% of your income away, you're good to go. For anybody in another service-based business, you can still deduct 20% of your income from your taxable income, as long as it doesn't exceed a particular dollar amount. Clear? So that's really the income side, right? The reduction in the individual income rates, and then the pass-through business 20% deduction that you're able to deduct from your taxable income. The next piece are the actual deductions themselves, right? So you have your income, you find what tax bracket you're going to be in. The next step is you're able to deduct a certain amount of your income from the income that you need to pay taxes on. It's really done in two different ways. First and foremost, you can claim what's called the standard deduction, where you deduct a fixed amount from your income before you pay taxes on it. Or you hear people talk about itemizing deductions, right, where you can list your charitable contributions, medical expenses, a wide variety of things to deduct the amount of taxable income that you have. I want to take those piece by piece because they're both changing a little bit. First and foremost, the standard deduction, the amount that anybody can reduce from their taxable income in any given year, is almost doubling for everybody. So for individual taxpayers, that standard deduction in 2017 was $6,350. That's going up to $12,000. And for married couples, that standard deduction is $12,700 in the old law. Now it's $24,000. So right away, you're able to deduct a lot more of your income from the top line under the new bill. Not only do most people have lower tax rates, you also are able to deduct more income, which is good news for a lot of people. The downside is the next part, and you're going to find that when we talk about these deductions and credits, you're going to go back and forth as to whether or not you're better off or worse off. And whether or not you're ultimately better or worse off really depends on the magnitude of each of these factors in your personal situation. The first factor is the deductions. Like we said, it's going up for just about everybody. It does mean that fewer people are going to be able to itemize deductions. We're going to talk about how that process is changing in a minute. But the actual itemization process in the tax bill, you only do that if you can itemize more deductions than your standard deduction. And if the standard deduction is higher, it's going to be harder to do that. So fewer people are going to do it. It really is going to make filing taxes easier for most people. The next piece, though, is what we've called under the old tax law exemptions. Not only were you able to take the standard deduction before, you were also able to take an exemption of $4,050 per person in your family. So if it's just you, you're able to deduct another $4,050 from your taxable income on top of the standard deduction. If you're married, you do that twice. If you had 3 kids and you're married, you do that 5 times, and so on. Right? So particularly for bigger families, having that, the standard deduction is just the same for every family. Having those exemptions really allowed you to deduct a lot more from your income the more children you have, essentially. That's gone from the current bill, or from the new law. You can still take those exemptions in 2017. Starting January 2018, you no longer have the ability to take those personal exemptions or exemptions for your family members. So again, right, that really negatively impacts a lot of people, particularly, like I said, larger families. Every family gets one standard deduction, but you could get as many exemptions as you had family members. So larger families who took a lot of exemptions really are at a disadvantage here. So what has happened is that the standard deduction has almost doubled for people, and then some of that got eaten away by removing these exemptions. Right? Overall, for just an individual or somebody who's married with no kids, this is still a win, because the standard deduction went up by almost $6,000 for individuals and almost $12,000 for married couples, and you're losing the $4,000 or $8,000 exemptions. So overall, it's a net win. until you start having kids. And for particularly large families, this piece hurts a little bit. And sorry, I see a question here. Can you define the standard deduction again? Yes, absolutely. So the standard deduction, you get your form from the IRS that says this is your taxable income for the year. You can deduct a certain dollar amount from that income before you actually pay taxes on that income. Most people, particularly going forward, are going to take what's called the standard deduction, which again is either $12,000 for individuals or $24,000 for married couples. That's up from a little over $6,000 and a little over $12,000. So like I said, that piece is doubled. We've removed the exemptions though. So overall, smaller families, it's still a net win. For bigger families, we're at a net loss at this point. Good question. Thanks for asking for that. The third piece, we've done the tax rates, we've done the deductions and exemptions. The third piece are tax credits, and there's a variety of tax credits out there. The one that really has changed in a big way in this law is the child tax credit. Under the current law, right, if you have children and your income falls below a certain amount, you would get up to $1,000 tax credit per child. That amount has doubled under this law, right? So now for every child you have that's a dependent of yours, you're able to take a $2,000 tax credit on your taxes. Now this is different than the deductions and the exemptions that we talked about a minute ago, right? The deductions and exemptions just reduce your income. Right? All the deductions and exemptions did was reduce your income, which in turn will reduce the taxes that you pay because you're paying taxes on a smaller amount, right? Tax credits are a direct reduction in the amount of tax that you owe. Right? So by increasing the tax credits that are available, bigger families who lost when we got rid of the exemptions before are going to be really benefited by this doubling of the child tax credit. They lost the exemptions, their taxable income is a little bit higher, but they're able to take a lot of just dollars out of the taxes that they owe from claiming this child tax credit, which is doubled. And not only has it doubled, but a lot more people are eligible for it in the first place. It used to be your income had to be relatively low to even qualify for the child tax credit before. Starting in 2018, the amounts have gone up drastically. So now individual taxpayers who are single and making under $200,000 a year can claim this tax credit, and married couples who have combined incomes over $400,000 or up to $400,000 a year can take this tax credit. The number of people who this affects has increased drastically, which is a net positive, certainly particularly for bigger families. So in summary, right, your tax rates overall went down for most people. The standard deduction has gone up. You lost the exemption, right? So most people are able to eliminate a little bit less of their, or a little bit more of their income than they were before. But as you start having kids, you likely have more taxable income than you did before. But for those people who have children and who lost the exemptions, you're able to take pretty big tax credits, $2,000 per child, of which, by the way, if you were to end up owing no income taxes whatsoever, $1,400 of that $2,000 per child is actually refundable to you. So if you don't owe any taxes and you have a couple of kids, you're going to get $1,400 per kid back, as long as the math works out. So really, like I said, for most families overall, you're in a better position than you were before when it comes to your taxes under this law. Certainly, we can argue whether or not cutting taxes like this is a good thing for society, but ultimately for you today, most people are going to end up better off, which is great. We've kind of talked through the different things you need to pay attention to about your personal situation to see if this is going to be a net positive or negative for you. The one other piece we haven't talked about, though, is the itemized deductions. If you in the past had actually gone through to itemize your deductions because some of the things that you could deduct actually exceeded your standard deduction, first of all, odds are it's going to be harder for you to do that because the standard deduction has doubled. But there are a lot of changes to the things that you can deduct under this law. Some are good, some are bad. So I want to quickly run through what those are. First and foremost, charitable contributions. If you donate to charity, you can get a tax credit for that. Or I'm sorry, you can deduct that from your taxable income. That actually, there was some talk about that going away under the tax bill. It's actually gone up. The amount that you can deduct for contributing to charity has gone up under this current bill. I'm not quite sure why it went from completely cutting it to increasing it, but overall, you can deduct more of your charitable contributions. Again, it's going to be harder to actually itemize that because the standard deduction has gone up, but you certainly are the marginal impact of the charitable deductions is higher under this law. The other piece that's gotten better a little bit is your ability to deduct medical expenses. That provision also, at least temporarily for the next couple of years, you're able to deduct a higher amount of medical expenses than you were before. It's going to go back to the way it was before in a couple of years, but overall, not a bad thing. The two big ones that got a lot of coverage and justifiably so, that are in some way, shape, and form in the final bill are, first and foremost, your ability to deduct mortgage interest. So if you own a home, you're paying a mortgage, the amount of interest that you pay on that mortgage is tax deductible. It used to be the first $1 million of principal on your mortgage, you could deduct the interest paid on that. There was some talk about eliminating it entirely. It's not eliminated. Instead, the amount that you can deduct is reduced a little bit. So now, rather than owning $1 million home or $1 million mortgage and deducting the interest on that, it's down to $750,000. So marginal change. Definitely, you lost a little bit of the ability to deduct that, but it's still there. And actually, if you've done it before, you haven't lost it, because this only applies to new mortgages. If you buy a house after December 15th, 2017, you're only able to deduct interest paid on the first $750,000 of your mortgage. If you've had a mortgage before then, you can still do the interest on the full bill. So it's a change going forward, not going back. The other piece that has gotten worse for a lot of folks is your ability to deduct your state and local taxes, particularly for people who are who have high incomes and are or expensive properties and in high tax cities or states. This one's a big deal for you too. In the past, you were able to itemize deductions for really an unlimited amount of state and local taxes. You could write that off of your taxable income for the year. You no longer can write off an unlimited number. Instead, they've capped it at $10,000 combined state and local taxes. So if your state and local taxes that you pay exceed $10,000 a year, you're able to write off the first $10,000 as a deduction, but no more. Again, for people in high tax environments, that one in particular is a really big deal. Unfortunately, not much to do about it. They were talking about getting rid of it entirely. They ultimately decided to compromise and keep a little bit of it. So again, right, the two pieces of this that really got significantly worse for a lot of people: new home buyers can only deduct mortgage interest on the first $750,000 of a mortgage. If you live in a high tax state and you deduct your state and local taxes, you can only deduct $10,000 combined from that amount. And there are a few other random things in here as well. In particular, I guess, alimony payments, or if you're divorced, or if you're getting divorced starting in January 2018. Before, when one ex-spouse pays the other ex-spouse an alimony payment, the person who paid the money was able to deduct that as an expense that they paid, and the person who received it had to recognize it as taxable income. Right? One person pays it, they're able to write it off. The other person gets it, and they have to pay taxes on it. No more, right? So the alimony payments are no longer a taxable transfer. One person pays the other person, there's no deduction or income recognized. And then finally, the other random one that particularly appeals to younger people is moving expenses. If you're moving around for jobs a lot, you used to be able to deduct your moving expenses when you filed your taxes. You're no longer able to do that unless you're in the military and you're being relocated for the military. You would be able to deduct your moving expenses. In that case, everybody else is kind of out of luck. So that really is the bulk of it. One other change, I guess, that I'll mention here is to 529 savings accounts. Classically, these 529s investment accounts or 529 plans were used to pay for college, right? They're a very tax-advantaged college savings plan, at least historically. Very high you can contribute a relatively high amount to them compared to some other tax-advantaged accounts out there. The money you put in is tax-free. The money that comes out is tax-free as long as it's used to pay for college. The use of those accounts under the new rule has expanded quite a bit, actually. You no longer can only use those accounts just for college. You still can use them for college, but you can also use them to pay really for any K through 12 expense, right? Private school tuition, you want to send them to a different public school and that costs you money for whatever reason. You can use 529 savings accounts to pay for those expenses now, up to $10,000 a year per child. So again, right, 529 accounts have been around forever. The use for those accounts has gone up a little bit. You can now put $10,000 a year per child. You can pull out of the 529 account to pay for K through 12 educational expenses. There was a provision in the bill that would have allowed you to apply it for homeschool expenses as well. That got cut at the last minute. So you can't use 529 funds to pay for homeschooling, but you can for other K through 12 expenses. Finally, I guess in wrapping up, there are a few things that are important that are in the bill. They really don't apply to too many people, and they actually apply to a lot fewer people now. The alternative minimum tax, if this is something that you were subject to before, primarily applies to really high income earners. That is still around. It's harder to qualify for it now. Much fewer people or many fewer people are going to be qualifying, quote unquote, to pay the alternative minimum tax. The tax is essentially, it was designed to stop really wealthy people from avoiding loopholes in their kind of standard tax bracket. It's still around. It's harder to actually trigger now. And the other thing is the estate tax. When somebody dies, the amount of assets that they have is taxed before it's inherited by the generation below it. You used to need to be really wealthy to have your estate taxed before. You used to need to have $11 million. Now you need to have $22 million in order to qualify for the estate tax. So if any of you out there are subject to that, then I'm sorry. You're doing pretty well, though, of course. Finally, in closing, a couple things that are not in the bill. I guess primarily one or two. The provision that would have taxed graduate student tuition waivers that got a lot of press. I saw a lot of articles written about it. That's gone, right? So if you're a graduate student who has some sort of tuition waiver from your school, you were under a draft of the bill going to need to pay taxes on that. You don't anymore, right? So that provision's gone. Don't worry about it. The other thing that was going to change and didn't had to do with student loan interest. You used to be able to deduct up to $2,500 of student loan interest that you pay in a current year. You still can do that, right? They were going to take it away on the final version of the bill. They didn't, so you're still able to do that, which is great. So ultimately, right, the grand vision of the Republicans in Congress when they first started talking about reforming the individual and family side of the tax bill was to make it really simple to file your taxes. They used to hold up postcards that said you'd be able to file your taxes on a postcard. It'd be that easy. It's not. Sorry, it's not, right? All these things that we've talked through, I've spent almost a half an hour talking through the big changes that were in the bill. We didn't even touch on the corporate side, right? There's a lot of complications here. Ultimately, like I said, for a lot of people, really for most people, this is going to be a net win and potentially a substantial net win for a lot of taxpayers. We talked about reducing the tax rates, increasing the deductions, significantly expanding the child tax credit. It is going to be a little bit simpler in the sense that, if you've itemized deductions before, you might not have to do that anymore because the standard deduction went up by a considerable amount. Might be a little bit easier for you. Overall, though, this is a net win for a lot of individuals. But there are still some kinks in the system, if you will. There are some people who are going to be rewarded relative to others. And that really is the spirit that I made the tax hacks that I mentioned at the beginning. There are several very easy things you can do, both between now and the end of 2017, if you're watching this in real time, and after 2017, right? To really start to take advantage of some of these things. Your paychecks are going to be going up, likely in February of 2018. Fewer taxes are going to be withheld. Around that time, there are going to be some things you can do to minimize some of the artificial flaws in this tax plan. Completely illegal, of course, but there are some things I recommend people do. And like I said, I have that tax hacks document pinned up at the top of the Facebook page if you're watching this live. It's linked to in the blog post if you're on the blog. And then if you're watching the replay of this video on Facebook, it'll be in the video description, the link about how to get that tax hacks guide for 2017. Thanks so much for joining me. Happy holidays, everybody. We're filming this live the day after Congress signed this law, right before the holidays. I spent my last workday pouring through tax documents. It's been a lot of fun. Let me know what you think, if this was helpful, if you like the content, if there's something we can do better. Absolutely, I'm really thinking about doing more of this in 2018. So would love your feedback. And it looks like I have one more question. Do we think this cut will last? Projections show that over time taxes will go up. Great point, and I should have mentioned this. I apologize for not mentioning this right off the top. There are two sides of this bill right now. There's the corporate side, and there is the individual tax return side. We're not talking about the corporate side because it doesn't really affect you as an individual taxpayer directly. On the corporate side, those tax cuts are permanent, right? They're flat out written into the law permanently. For a few different reasons, your tax returns, right, your tax cuts are not permanent. They are set to sunset in 2025, right? So we have several years under this new tax law before they expire. They could be extended at that point. They might not be, right? So historically, President George W. Bush passed tax reform bills in 2001 and 2003 that were also temporary, and then were extended permanently by Congress several years later when the deadline was approaching. That might happen again. It might not, right? So I don't see any way that we can know whether or not this is going to be permanent or not. Right now in the law, it's not. But that again, that doesn't mean that. To me, that doesn't really mean anything for your strategy right now, right? Your strategy right now is your taxes are likely going to be going down. Maybe prepare for them to go back up someday. But like I said, there's a lot of stuff that you can do right now to really take advantage of this. Great question. And with that, I'm going to sign off. If you have any other questions, certainly either shoot our Facebook page a message or email me at bill@pacesetterplanning.com. Make sure you grab that tax hacks guide, and happy holidays, and we'll see you in 2018.